The game drastically changed just when you believed the market had revealed all of its cards to us. Welcome to a point in the history of the stock market when the unthinkable happens. The financial world held its breath in expectation only a few moments ago. Wall Street is reeling from a bombshell that Tesla's mysterious CEO, Elon Musk, just dropped. Tesla said this morning via tweet that Tesla will ask shareholders to vote at this year's annual meeting to authorize additional shares in order to enable a stock split. The same was explained in a fresh 8K that Tesla submitted to the SEC this morning. The wording employed there may be confusing, but it refers to a stock dividend even if it talks about a dividend. This is not Tesla establishing a quarterly cash dividend. Rather, this is precisely the same split mechanism that they previously employed. Phil Bowe of CNBC tweeted this morning, stating that Deutsche Bank had increased their Q1 earnings projections. According to Phil, Deutsche Bank said they're raising their estimates because beyond this quarter, we remain impressed with Tesla's operational execution in the face of industry supply chain challenges and with its pricing power, which would enable it to more than offset steep raw materials pressure. I haven't seen any articles on this, thus strikingly similar to the insights that other analysts have shared with us. We're delving deeply into this groundbreaking announcement in today's special edition. What effect will Elon Musk's most recent action have on Tesla's stock? What effects will this have on investors, the market, and this electric vehicle powerhouse's future? Come along with us as we solve the puzzle, analyze the ramifications, and investigate the unexplored areas of Tesla's market trip. We can help you with everything from the little print to the big picture. This is Tesla Stock News, where finance and the future collide. This isn't just another market report. We're going to take you on an exciting journey through the world of stocks, strategy, and Elon Musk's brilliance, so stay tuned. Enjoy this exciting edition of Tesla Stock News, folks, and don't forget to like and subscribe to our channel. Now, let's get going. With the holidays well underway, there's a special subject that needs our focus: the possible third stock split for Tesla. We haven't talked about this topic on this channel previously, but it seems appropriate to do so now that we're on the verge of what appears to be another significant breakthrough for Tesla. It's critical to comprehend a stock split's advantages and disadvantages. Though keep in mind that past performance does not guarantee future results, Tesla's behavior during its last two stock splits historically paints an interesting picture. Tesla's shares surged 81% during the first split in August 2020 between the announcement and the actual split, and then fell 14% in the next month. Still, the stock bounced back, rising almost 36% in the 6 months following the split. The number of shares was effectively quintupled, and the share price was decreased by a fifth as a result of this 5-for-1 split. In August 2022, Tesla revealed its second split, which would be a 3-for-1. The intention was to increase employee and investor access to equity ownership. Tesla's shares was trading about $1,900 before to this split, which is a significant decrease from nearly $2,000 prior to the initial split in 2020. The price rose almost 46% to nearly $1,315 per share after the announcement, but after the split, it fell 15%. Elon Musk, the CEO of Tesla, started talking about the company's acquisition of Twitter and the subsequent selling of Tesla stock, which was a big turning point in the company's history. During this time, it has been noted that Tesla's stock has increased significantly after its previous two splits, with the first split performing better than the second due to different market conditions. Market conjectures indicate that 6 to 7 rate cuts may occur as we move closer to 2024, which would result in a situation similar to what happened in 2020. Interest rates aren't zero, but they are trending lower, which improves market liquidity. Rate reductions are one tactic used by central banks, such as the Federal Reserve in the U.S., to boost economic activity. Interest rates can be lowered to make borrowing more affordable for businesses and consumers. Spending and investment rise as a result, which may contribute to faster economic growth. The projected 2024 scenario is similar to the 2020 economic climate. Global central banks lowered interest rates to almost zero in reaction to the COVID 19 epidemic in an effort to lessen the economic impact. These reductions were a part of a larger plan to keep the market liquid and stimulate investment and expenditure in an uncertain world. Although a historic low in interest rates is not anticipated in 2024, the anticipated rate cutting cycle suggests a move towards a more active market. Liquidity often rises when interest rates are lower. The economy can circulate more capital when borrowing becomes more affordable. Consumer spending on products and services may increase, and businesses are more inclined to invest in growth possibilities. A livelier and more active market may result from this. After a time of controlling inflation or the economy recovering, the anticipated rate decreases in 2024 may indicate a change in economic objectives. It's possible that central banks want to promote growth, but the delicate balance makes sure that these cuts don't overheat the economy and lead to inflationary pressures. Interest rate reductions are often seen favorably by investors. When rates are lower, stocks may seem more appealing than bonds, which could encourage more people to invest in the stock market. Cheaper borrowing costs also benefit businesses, which may enhance their stock prices and financial performance. This stands in sharp contrast to the circumstances of 2022, when there was a constant depletion of market liquidity. A more accommodative Federal Reserve is hinted at for the future year, which might create a positive market climate, particularly for interest rate sensitive equities like Tesla, and could have an effect on small and mid-cap stocks. There has been increasing talk about a possible split of Tesla stock in the upcoming year. A stock split seemed improbable a few months ago, when Tesla's shares were trading between $150 and $200. Nonetheless, the discussion has gained credibility given the stock's potential to soar to new heights in 2024. Forecasts for 2024 vary from a dismal prediction of approximately $350 per share to a bullish scenario of $600 per share. According to a November 4th, 24/7 Wall Street story, there is a chance that Tesla would split again if its shares surpass $400 in 2024. Making the stock more accessible is one of the main causes of this, particularly for people who are unable to buy fractional shares through specific brokers like Vanguard. Additionally, stock splits make employee stock-based pay simpler. It's interesting to note that previous stock splits have acted as triggers, greatly raising market awareness for Tesla. For example, the share price of Tesla increased by 81% in August 2020 when the split was announced and carried out. Although stock splits don't necessarily raise a company's value, they have traditionally drawn greater attention from investors and inflows from the general public, which has presented difficulties for short sellers. Moreover, Tesla might be positioned as a prospective member of the Dow Jones Industrial Average through another stock split. There isn't one carmaker on this esteemed index, which includes 30 of the most well-known businesses in America, since General Motors was eliminated in 2009. Due to its success and reputation as a recognizable American brand, Tesla is an appealing contender. But since the Dow is price-weighted, Tesla's stock price will have a big impact on whether or not it is included in the index and how much weight it is given. Only one Dow component is trading for more than $1,500 a share as of late 2023, indicating that Tesla would prefer to trade between $100 and $1,200 a share rather than at higher levels above $1,400. There is growing support for Tesla to split a third of its equity, especially if its price rises over $400 or perhaps $350 per share. This action might have a big impact on the Dow Jones Industrial Average, preventing Tesla's performance from having an outsized effect on the index. With a $1,400 share price, Tesla's market value at 2024 might be close to $1.25 trillion, which is a reasonable goal considering the company's current trajectory. Tesla has maintained its impressive performance in the face of inflationary pressures and the highest interest rates in its history. A rate cut that is expected to occur sooner than the market anticipates could result in new car financing being more affordable, which would increase consumer spending power and Tesla's sales in 2024. Tesla may raise the price of its cars, emphasizing the part that customers care about most, the monthly payment. A monthly payment of $1,650 to $1,700 is easier to manage than one of $1,900 or more, so affordability becomes crucial. Although it affects profitability, this price plan may ultimately be more affordable for customers and advantageous for Tesla. Even by the company's standards, Tesla's current valuation is modest and reflects the realities of the market. The market's mistrust of Elon Musk's remarks made during earnings calls and high interest rates have also affected the performance of Tesla's shares. There is still opportunity for valuation growth in 2024, though, as the price-to-earnings ratio may drop back to about 100 from its top of 1,200 in 2020 and 2021. With a $4.50 earnings per share, Tesla's stock might be worth $1,450. The stock price may rise even further and lead to another stock split if EPS beats forecasts. A split can increase the stock's accessibility to a wider group of investors, particularly those who lack access to fractional shares, even while it has no effect on the company's fundamental valuation. The stock price may rise as a result of this accessibility. Companies such as Berkshire Hathaway, whose shares are in extremely high demand and whose stock price is highly volatile, see daily variations in their stock price. A stock split can somewhat stabilize the stock's fluctuations by increasing the number of shares while lowering the price of each individual share. By raising the number of outstanding shares, Tesla may be able to maintain its valuation and attract more private investors to its stock. In the event that Berkshire Hathaway splits its shares multiple times, there is conjecture that the stock would be less volatile and would experience less severe drops in value over any given time frame. This can result in a more steady valuation for the business. Based on its two prior stock splits, Tesla has demonstrated that these kinds of moves can help keep stock prices high even when the business makes strategic choices like price reductions. Although there have been changes to Tesla's price and fundamentals, the stock is still much higher than it was in 2019. The stock splits are thought to have contributed to the preservation of this value. Stock splits may also benefit individual investors to a lesser extent. For instance, in the event of a 1-for-4 stock split, a shareholder in Tesla with 25 shares would now own 100 shares. The rise in the number of shares allows the shareholder to take advantage of different investment tactics, such selling calls or looking into more reasonably priced options trading. Experts claim that stock splits have benefits like lowering the price of shares and maybe rekindling investor enthusiasm, but they can also cause volatility, which is frequently observed in a sell-off following a split. A stock split has no immediate effect on the total value of an investor's holdings in the business. On the other hand, if Tesla decides to pay dividends in the future, it is theoretically possible that stock splits will result in higher dividend payments over time. Looking ahead, strong investor activity and strengthening market conditions might lead to a 50% or greater surge for Tesla if another stock split is announced. The market as a whole may start to exhibit comparable patterns in 2024, which would be quite beneficial for Tesla's shares given the noteworthy inflows of retail investors into the company. In the second half of 2024, a stock split makes sense, particularly if Tesla keeps up its impressive performance. Short-term projections for Tesla's stock include the possibility that it would trade beyond $1,300 per share due to good economic indications like declining inflation and the launch of fully autonomous driving technology in the Chinese market. Early in 2024, significant capital is expected to join the markets, which could propel Tesla's stock to unprecedented heights. It is not a good idea to buy Tesla shares just because there might be a stock split, but it is possible that the company's stock value might increase significantly as a result of the split. The possibility of multiple rate cuts in 2024 is causing a stir in the financial world, reminding people of the economic tactics employed in 2020. These reductions point to a move toward a more accommodating monetary policy, even though they don't reach the catastrophic lows of the pandemic era. This shift may result in higher market liquidity, boosting economic expansion, and improving investor mood. Let's think about a couple queries now. What impact will these projected rate reductions have on your investing approaches? Do you believe that a stronger economic rebound may be around the corner? Furthermore, how can Tesla, a significant participant in the stock market, manage and profit from this shifting financial landscape? I'd like you to jump into the conversation and offer your opinions. Remember to subscribe to Tesla Stock News and hit the like button if you thought this material was insightful. This will provide you with additional updates and analyses on the changing dynamics of the market. We appreciate your time and hope to see you in our upcoming videos.